I am disappointed with the revenue performance that we had in Q1. We grew by 2.2% in reported terms, and I had expected that we'll do better, and this happened because of some unanticipated slowdown in some discretionary parts of consulting and package implementations, and also some of the large deals that we had won in the quarters before were slower to ramp up their projects. So as a result, the revenue performance was not quite what I expected, but at the same time, we had very strong performance in almost all the other metrics, and I am quite encouraged by that. In particular, in the execution of our strategy, we had strong performance in our delivery organization, which has been renewing itself at a frantic pace on the basis of zero distance and collaborative grounds-up innovation initiatives like that, on the basis of design thinking spreading pervasively, as well as on the basis of automation, where we saved additional 2,000 plus people worth of effort, as well as in large deal wins. We crossed $800 million in large deal TCV wins. Utilization improved in almost every major metric in our top clients, in our top 5, top 10, and top 25 clients. We grew significantly faster than the overall company. And what I'm most encouraged by is that our new services and our new areas, in particular our Mana platform area, our work with Scava, with Edge products, showed significant improvement, and that gives us quite a bit of reason to be excited as we look ahead to the future. So given the slowness in performance, in particular in consulting and related areas, where we lost in the neighborhood of about 1% or a little bit more than that we had expected, we are lowering our guidance for the overall year, given the visibility that we have in that part of the business, as well as in looking at the overall situation and so forth. But by and large, we continue to be excited about our execution on our strategy, in particular both in the renewal of our existing services and especially in the new areas that we are bringing, that we are counting on as a way to transform our company to one where software and automation becomes an integral part of how services are delivered, so that we can continually bring innovation, free people up to be more innovative, as well as continue to lower the cost and improve the margins of our company on our march towards our 2020 ambition of $20 billion, 30%, and $80,000 revenue per employee. So with that, I would love to open it up to some questions.
A couple of questions, really. The slowdown that you have reported this quarter, is this a one-off thing, and what is the visibility that you have for the rest of the year? Also, in terms of the guidance cut, it's come in as a surprise to the street. Just wanted to understand what is mandated this. And also, if you can elaborate on the volume growth front, we have seen a little low side on that side as well. If you can, tell us on all these.
Okay. Yeah, so as we look ahead, we are extremely encouraged by the performance, in particular in the new services, as well as in the renewal of our core services, and in the large deal wins. So these three are going to help us continue to deliver good performance over the rest of the year, and obviously we will work very hard to get back to the kind of performance and even exceed the performance that we have seen in the recent years. But the slowdown that we saw in a couple of these areas, since the nature of our business is that in the beginning of the year, if you do this, then it takes a bit longer to recover from that, and so that's why, and some other uncertainties, macroeconomic uncertainties that we see. So altogether, when we were looking at it, given that we did 2.2% in the quarter, which is 1.7 in previous quarters constant currency rates, we are lowering our revenue guidance, but we are continuing to be very confident about the direction that we have in both areas, in both the renewal of all our existing services, which have showed a significant momentum, as well as in particular in the new areas where our new offerings are already. In Mana, for example, we just launched it this quarter, and we have already seen the first clients purchase it, go and already start to become successful with it. So that is something that we are extraordinarily happy about.
Hi Vishal, Chandra here from ET Now. I have questions for all three of you, so I'll just go one by one. Now, Vishal, you sound pretty subdued compared to the optimism that you radiated in the last 4 quarters. I don't know if it's a sign of things to come, but just want to start by asking you, what has changed so dramatically in 3 months? Usually we see companies, lowering guidance or going back on their stated guidance, perhaps 2 or 3 quarters into a financial year. So, why did the management have such poor visibility into just 1 quarter? And how are you sort of going to assure shareholders that, your visibility for the next quarter, is not so bad and, you will deliver on your stated number? Praveen, you flagged off some of the headwinds mid-quarter. You said that there will be some bump-ups, volatility because of weakness in energy and insurance. Are these the problem verticals? Are there more and will they continue? And Ranga, coming to, the deal growth has been very robust, but it's not getting reflected in terms of the revenue growth. So, is pricing again under a lot of pressure, and is it only going to get worse because everybody is talking about commoditization of existing businesses? And, if you can just give us some color on that. Vishal, starting with
So I don't know about being subdued. I am, as I said, I keep a long-term view on things when times are good as well as when times are not so good. So I'm actually extremely encouraged by, I've been here now, I was in Bangalore for several weeks, meeting with the teams and so forth. And I'm actually quite excited about how our strategy is being embraced in a massive way, both in renewal of our existing services and in the new areas that we have launched, how we have started to rethink our client engagement with design thinking in a very pervasive way, which is now reflecting in a consistent large deal win rates. Look, this is at the beginning of the quarter, as we were ending the previous year, we did not anticipate the slowdown in the discretionary parts, in particular in consulting. This was certainly something that we did not expect at the beginning of the quarter. And also, some of the large deals that we had won in the previous quarters, in the previous quarter, we won close to $750 million of large deals. So we expected that those projects will ramp up and so forth. And that ramp up has been slower than we anticipated. A couple of the very large deals that we won started towards the end of the quarter and so forth. So as we look ahead to the rest of the year, barring the fact that we had a couple of these slowdowns and in a couple of parts of our business, all the parts of our strategy are actually functioning or firing on almost all of the cylinders. So I'm really excited, and obviously we have to give our guidance to the market based on what we see and looking at the overall situation. Brexit just happened. So far, Brexit has had no impact on us, but as we look ahead to the future, clearly this is something that many banks are worried about and so forth. So it creates this opportunity for us in the medium to long term. But in the near term, we don't know how this will play out and so forth. So given that visibility, we lowered our guidance by 1 point, which is, not that much. And obviously our team is committed to working on it and ensuring that we deliver strong performance. But we have to guide the market based on what we see, and this is what we see presently.
From a vertical perspective, we saw good growth in retail and CPG, about 5.5% growth. We saw very good growth in telecom. Banking and manufacturing was good. Banking, if you ignore Finacle, was over 3% growth. Insurance actually did well. The 2 areas where we didn't do well, one was expected, which was energy, with degrew. Life sciences was a bit of a surprise for us. We didn't anticipate in the beginning of the quarter. But to some extent, life sciences was also massively hit by the slowdown in the discretionary spend that Vishal talked about earlier in the consulting and package implementation, and life sciences bore the brunt of it. So we hope that it's not a cyclical trend on the life sciences thing, and it should recover over a period of time. Barring energy, I think right now we feel fairly confident about rest of the industries.
Well, I think while there is a lot of focus this quarter on the revenue from the kind of questions, I would also like to highlight the margin part of it. So if you look at the operating margin for this quarter, it's at 24.1%. And we did reasonably well on margin front. For example, if you look at the Q1, typically we have compensation increases, which had an impact of 1.4%, and the visa charges, which is about 0.8%. But we were able to offset all that and maintain the operating margin at the same level as Q1 of last year through cost optimization measures. And many of the cost optimization measures, whether it is utilization going up and the subcontractor expenses as a percentage of revenue coming down, and some of those factors continue to happen in terms of which is positive. While you asked the other question of the deal ramp up, as you know, this quarter also we won a little over 800 million. Now, typically when we win a deal of a TCV, roughly about 7.5 to 10% of that TCV converts back to revenue in the first year. That has been a thumb rule. Now, we expected the deals that we had won in the earlier quarters to quickly ramp up in Q1, and some of them have actually, and a couple of surprises were there which had got pushed back to the subsequent quarters. So that's the thing about the conversion. Coming back to your question on pricing, if you look at in constant currency on year, the pricing drop has been pretty much 0.2%. So the same kind of pricing drop that we saw has not been significantly different from what we saw earlier. And as we have said in the past, this pricing drop will continue we need to offset through the operation efficiency and productivity improvements in the company. And some of the trajectory that we have seen on utilization, subcon expenses, on-site employee costs as a percentage of revenue, we held at 39.3, which is same as last year. So some of these things, we will offset the price decline. And overall, I think on the margin front and the cash flow generation, it is 33% up as compared to Q1 of last year at a little over 400 million. And these are some of the factors which I would like to highlight in addition to the revenue part, where the trajectory that we had assumed when we gave is in the right direction.
Vishal, hi, this is Sajid here from Bloomberg Quint. You gave a constant currency guidance of 10.5 to 12%. Can you elaborate on the dollar guidance, because it was around 11.8 to 13.8? What will be that dollar guidance now? Secondly, color on the kind of deals which are coming from European Union or the Europe as a continent for you. Will there be a hold up with respect to those deals coming in? And how is the banking and financial vertical work doing for you in that sense? For Praveen, the attrition rate has gone up to 21%. What's the reason for that from 17 point something to nearly 21%? What is it that, despite a good wage hike which you did, I think still the attrition has gone up. And for Ranga, the EBITDA margins has come down to 24.1%, as you said. Is the street going to bring down? You had given a band of EBITDA margin, 26 to 28. Now, 24 to 26. Do you think you will remain at the lower end of the band, or you have that potential to go up to 26% by the end of the year?
So the kinds of deals that we have won are all over the world in all geographies and also in Europe. So there is, in terms of the large deal wins, there hasn't been a slowdown. So we are excited about that, and we want to bring in the new mix to these large deals as we start to execute on these. In terms of the impact of Brexit on Europe and so forth, it is too early to tell. Clearly, some of the banks are in a state of trying to figure out what this means and what are the kinds of changes that they will need to make and what that means for near-term spending and so forth. But my sense is that as unfortunate as some of these walls that are getting created because of things like Brexit it does create more need for services, more need for integration, more need for ways to interoperate across boundaries and so forth. So in general, that will mean additional opportunities for revenue growth. But at the same time, in the near term, I think that we might see some uncertainty due to this. But it is too early to tell. So far, I want to clearly say that so far we have not seen any impact as a result of Brexit. Oh, the dollar guidance. So what we had guided in the beginning of the financial year was 11.5 to 13.5 on constant currency, on FY16 constant currency, and that amounted to 11.8 to 13.8 on March 31. So that 11.5 to 13.5 has now become 10.5 to 12. And that corresponds, the 11.8 to 13.8 that we had guided earlier becomes, Ranga, correct me, 10.8 to 12.3.
Correct.
10.8 to 12.3 in March 31 currency.
Just to add to the guidance, if you look at when we guided 11.5 to 13.5, typically you see the Q1 is an important quarter, and every 1% drop in Q1 growth rate typically impacts the overall growth rate by about 1%. So at the same time, we have taken into account some of those aspects and the visibility we have at this point in time. If post Q2 performance things change, we will again relook at our guidance in terms of, if things pan out to be better than we expected, or is it same as what we see today. That assessment we will take later on.
On the attrition front, while the attrition has increased as compared to previous quarter, part of it is to do with the seasonality. Because typically in quarter one, we have a higher exit due to higher studies and so on. We are really encouraged by the fact that we also track high performance attrition, and there actually it has come down. Earlier last quarter it was 13.4%, and this quarter it has come down to 11.2%, so we are encouraged by that. So at this stage obviously we have to watch out, but at this stage we are not unduly concerned. And we continue to do many things on the employee front. Just today we announced we relaunched our ESOP program after a gap of 10 years plus, after a gap of about 13 years. For starters, we are rewarding about 7,500 of our employees from junior to middle management with restricted stock options, and we will extend it to middle management, to senior leaders and title holders subsequently. We continue to focus on reskilling employees. We have revamped our leadership development programs. We have launched many initiatives around career mobility, mentoring, and so on. So we continue to focus a lot on employee experience and employee engagement. So at this stage, even though the attrition has increased, we are not really concerned at this stage. Obviously, we'll continue to watch out for it.
Yes. So coming back to the margins, as I said earlier, if you look at Q1, the operating margin is 24.1 is reasonable, because every Q1 we have two pieces of additional costs as compared to previous quarters, which is really the compensation increase which we announced, which has impacted the margin by 1.4%, and visa charges 0.8%, which we were able to offset through cost optimization measures. The key thing is to compare it year-on-year basis. For example, Q1 of last year it was 24, it is 24.1. Having said that, there are several cost optimization measures, whether it's utilization, subcon expenses, which I have talked about earlier. We have been able to reduce, for example, the subcontractor expenses, which hit a peak of 6.3% in Q3, came down to 5.6% in Q4. Now it is 5.4% in Q1. So the trajectory is in the right direction. Likewise, the utilization consistently over the last 5 quarters is above 80%, excluding trainees. We further improved it this quarter. We feel there is scope for improvement there as well. Whereas some of the other levers like the on-site effort mix did not show improvement. We want to work on it. Likewise, on the on-site employee cost is 39.3, which is kind of stable as compared to last year. Margin is a derivative of two things. One, of course, the cost optimization piece, which we'll continue to do and which are progressing well, and it is also part of the revenue trajectory. Now, we had given a medium-term revenue guidance of 24 to 26. We stick to that for the medium term. As a revenue trajectory for the balance 3 quarters, we need to watch. If the revenue trajectory, keeping in view whatever we have given the revenue trajectory, at this point in time, we are looking at comfortable with 24 to 25% margin, and last year we ended at 25%. That's what we are seeing.
So, what is the reason for decline growth in India, which declined by 7.6% quarter on quarter?
Yeah. In India, it's a very small percentage of our business, and we typically execute system integration projects. So sometimes some projects end, and so that consequently results in decline in revenue. So in India, given the small base and the nature of projects that we execute, we continue to expect volatility quarter on quarter, and I don't think we should read too much into the India unit performance.
Yeah, Adit Chali from CNBC TV. Just a couple of quick questions. In terms of the project ramp downs, rather the projects not ramping up in Q1, could you give us some sense on, where are these projects from in terms of geographies and verticals? Secondly, I believe that the Mana platform head has moved on. Have you identified a replacement? And thirdly, Vishal, your previous employer, SAP, recently said that Brexit could also be an opportunity in terms of, the kind of projects that will come up on the governance side, on integration, on new systems. Would you share that optimism?
So, yes, I do share, maybe I can start in the reverse order. Yes, I do share that optimism. As I said earlier, it is unfortunate that this Brexit kind of a thing means that more walls get created between organizations and institutions and societies. But nonetheless, when there are more walls, then there is more opportunity for integration, for interoperability and transparency across the boundaries and so forth. So this would mean more business over time. Nonetheless, in the near term, people are still trying to figure out what this means and so forth, so there could be some uncertainty. The Mana platform head has not left. Mana platform head is Naveen. Samson has left. He was the head of our cloud and infrastructure services. He used to run also the Mana implementation services. So he was a long-term employee of Infosys, and we wish him well, but the Mana team and the Mana platform is very much within the company. Yeah, the ramp-ups were across geographies. One large deal that we had won in healthcare area in North America started a little bit later than we expected. And one in Europe in the financial area started a little bit later than we expected. As well as in the life sciences area, some of the consulting projects were impacted by unanticipated, discretionary spending related areas and so forth. So that is basically what happened.
Yeah. Hi, Chandra again. Just final couple of questions. Vishal, what does this do to your 2020 aspirational target? I know it's, an aspirational target, but would you need to reset that in terms of revenues or even on the margins front? Because a 5% uptick in 3 years looks challenging. And also, Ranga, just wanted to clarify again, you're saying the margin band will be 24 to 25 instead of 24 to 26? If you can just clarify on that. Vishal.
So, in terms of the 2020 ambition, it doesn't do anything to it. That is our aspiration. I believe that is the right direction, right aspiration for the company to have. As I have always said, there is not a goal. It is, if we are able to execute and continue to execute and bring to scale the kinds of changes that we are doing, then this will be a consequence of the work that we do, and we'll look back on it with great success. And we are on that trajectory. I think that if you look at revenue per employee overall for the company, that has gone up slightly, and that has been, I think that is a direct result of, on the one hand, the high margin non-linear growth that we see in the new software areas, as well as better utilization and the deployment of zero bench, for example, which is our initiative to more or less eliminate the notion of a bench in our industry, which has now touched close to 100% of the folks on the bench. 99.5% of people on the bench have performed at least one job that is on our zero bench marketplace. So I'm extraordinarily encouraged by that. I think you start to see that in the productivity improvements. And for the first time in a few quarters, we have been able to decline that trend, and the revenue per employee is starting to go up, and our aspiration continues to be $80,000. So the 2020 aspiration is still very much what it is, and one 90-day cycle doesn't hold us back on going after that. Ranga, on the margin.
Yes. So as I said earlier, in the margins, our medium-term band continues for the medium term, 24 to 26. If you look at this quarter, we're at 24.1, and it is same level as last quarter, last year's Q1. And Q1 always has typical compensation hikes and visa charges. Compensation hike impacted 1.4% and visa. But we were able to offset through the cost optimization measures that I talked about on the subcon expenses, as the utilization improvement and the on-site role ratio and so on. Now, every year, the Q1, these are the impacts, and during the balance year, some of these impacts get recovered. Now, if you look at the margin, the question that you asked for the short-term margin guidance, margin is a combination of both revenue trajectory as well as the cost optimization. I believe that cost optimization parameters are moving in the right direction. We'll continue to push those pedals and the levers which I talked about, the utilization, subcon expenses, on-site effort mix, on-site role ratio, and so on. Now, given the revenue trajectory that we foresee at this point in time for the balance 3 quarters, the short-term band range for the operating margin is 24 to 25. Our medium term, we still reiterate 24 to 26. Short term, we'll see how the Q2 really pans out. So for the short term, we'll reiterate 24 to 25. Short term is something we have to see how the next couple of quarters pan out.
For the year, we are keeping it at 24 to 26.
Yeah.
Okay.
Thank you.
Thank you.